Oil and gas investments have shocking tax benefits. In fact, these benefits are so powerful that they rival even those of real estate, which are among the best in the entire tax code. Today, I'm going to explain everything you need to know about oil and gas investments, including what they are, how they work, and most importantly, what are the key tax benefits of investing in oil and gas. Without further ado, let's dive in. All right, guys, what are oil and gas investments? Oil and gas investments are investments that you can make related to the creation of oil and gas wells. You see, oil and gas wells serve the purpose of drilling into the earth to extract oil and natural gas. There are a variety of types of gas that might come out of a natural gas well, including butane, propane, pentane, and many more. But once the oil or gas company successfully completes the well, the oil or gas is extracted on a continuous basis until the well is depleted. After it is extracted, the oil or gas is sold for cash. The cash is then distributed to the investors, and this is how oil and gas investors make money. Oil and gas wells last for varying amounts of time. For example, some might only last for a few years because they're depleted, but others might last for 20 or even 30 years. The longer that an oil and gas well lasts, the more money that investors can make from it. Oil and gas wells are similar to real estate investments in that they generate real cash flow. Real estate investments generate cash flow through rental payments, and oil and gas investments generate it through continuous sale of the oil and gas that is produced from the wells. So what are the tax benefits of investing in oil and gas? Two of the largest expenses for oil and gas investments are tangible drilling costs and intangible drilling costs. Let's discuss tangible drilling costs first. Tangible drilling costs are the cost associated with the actual equipment that will be used to drill for oil and gas. Now, these costs usually represent about 20 to 40% of the total cost of drilling a well, and they're 100% tax deductible. This means that oil and gas investors can write off all of the money they spend on tangible drilling costs. However, the deduction has to be taken over 7-year depreciation schedule. So, in other words, you will be able to write off the full tangible drilling costs over a period of 7 years. Now, intangible drilling costs are all of the other costs that go into drilling a well besides the actual drilling equipment. These costs can include the drilling mud, the grease, the labor, which is the most, survey work, supplies, clearing, drainage, fuel, and much more. Intangible drilling costs usually represent about 60 to 80% of the total cost of drilling an oil and gas well. And guess what? These costs are also 100% tax deductible. You see, independent producers are allowed to deduct 100% of these costs in the year that they are incurred. However, corporations can only deduct 70% of their intangible cost in the first year. The remaining 30% has to be deducted over the course of a period of 5 years. But here's the bottom line. Oil and gas investors get to deduct both tangible and intangible drilling costs, which translates to huge tax breaks and losses on the return that you can offset your W-2 and your 1099 income. To understand how powerful these tax deductions are, let's say that you invest $100,000 into an independent oil producer. In the first 2 years of your investment, you would be able to deduct about $60,000 to $80,000 in intangible drilling costs alone. Now, this is absolutely massive. Make it even better for certain oil and gas investments, you can use losses to offset other forms of income, such as income from W-2 or 1099. So if I invested that $100K and I got a $60,000 to $80,000 write-off, maybe I didn't cash flow as much from my oil and gas investments, and now I have an active loss on the tax return that I can use to offset my W-2 job or my 1099 business. So this makes the tax benefits of oil and gas investing even more powerful. Let's talk about small producer depletion allowance. The small producer depletion allowance is another great tax break for oil and gas investors. This tax break excludes 15% of gross income from oil and gas wells from taxation for people who are considered small producers. What this means to you is if you invest in a small producer, then 15% of your cash flow could be tax-free. This highly impressive tax benefit of oil and gas investing helps to draw a lot of investors into the sector, even though there happens to be risk in investing in oil and gas from a cash flow perspective. How do oil and gas investments really work? There are many different ways to invest in oil and gas, but here's a look at some of the most popular ways. Working interest. You see, a working interest refers to a type of oil and gas investment in which the investor can actually own a percentage of the oil or gas well. This is the type of oil and gas investments that has the most tax benefits amongst them all. The reason why is because people who invest in working interest for oil and gas wells bear some of the cost of the setup and operation of the well, even though they could be investing in it passively. These costs include both the tangible and intangible drilling costs that I discussed earlier. Now, in exchange for contributing to the cost of production, working interest owners are given a right to the percentage of the profits of the resources extracted from the well. If an oil or gas well is successful, then that can result in a substantial amount of profits for investors who have working interests. But the reason why this type of oil and gas investment has the most tax advantages is because investors are responsible for the cost of setting up and operating the well. For this reason, working interest investors get to deduct all of their tangible and intangible drilling costs within the first year of making their investment. With a working interest, yes, there is risk, but you also get to deduct your entire investment, or at least the vast majority of it. And this can produce a loss on the tax return that can offset your W-2 and your 1099 income without you having to qualify for real estate professional status or doing the short-term rental rule or materially participating. Also, importantly, a working interest is not considered passive income by the IRS. This means that it is not subject to the passive activity loss rules of 1986. As a result, oil and gas investors with working interest are able to use the losses from their investments to offset other forms of income, including W-2 and 1099 from their primary jobs or businesses. Guys, this is extremely significant because it dramatically increases the amount of income you're able to deduct from your tax returns, reducing your overall liability. Additionally, 15% of the cash flow from your oil and gas working interest investment might be exempt from tax. Whether or not it is depends on if the working interest is with a small or a large producer. Small producers are entitled to the tax benefit. Working interests are not considered to be securities. If you would like to invest in a working interest in an oil and gas well, then you can do research to find companies that are offering this opportunity. Working interest investments for oil and gas companies tend to have larger minimum investment sizes than many other types of oil and gas investments. So these investments are typically reserved for middle to high class who can afford to invest thousands and thousands of dollars into the oil and gas sector. In fact, the majority of private oil and gas investments in wells are only available to accredited investors. And an accredited investor is someone who has a net worth of over $1 million, excluding their primary residence, or who has made at least $200,000 per year over the last 2 years, or $300,000 combined together with a spouse, with an expectation to make a similar amount in the current year. So, working interest investments are primarily for high earners, high net worth individuals, and if you fall into this category, then these investments could be good for you in combination with other strategies. Let's talk about royalty interest. With a royalty interest, it's an alternative to a working interest. With a royalty interest, the investor owns a portion of the resources that are extracted from the well without having to be liable for the cost of operating the well. Because royalty interest holders are not responsible for a lot of the risk and operating costs that working interest owners are responsible for, they don't get to access the same tax benefits that the working interest holders get access to. So if your primary goal is to use oil and gas investments for tax benefits, then a working interest would make more sense and would be the better option for you. However, if your goal is to minimize risk while still generating cash flow, then you might want to look at a non-working interest and benefit from the oil and gas sector. The royalty income that royalty interest holders receive every year is reported on Schedule E inside of the 1040 form. Although royalty interest investors are not able to get as many deductions as working interest investors, they can still get access to some of the tax benefits. One tax benefit that many royalty interest holders qualify for is the depletion allowance, which allows them to have 15% of the income from their oil and gas investments exempt from taxation. That's amazing. Oil and gas stocks are also prevalent. Buying oil and gas stocks is another way for you to invest in oil and gas if you're interested in the sector. There are many different oil and gas securities available for purchase on the stock market. Oil and gas stock investments are subject to capital gains taxes and taxes on dividends. So keep this in mind. Also, these investments do not have the same tax benefits that working interest investments or royalty interest investments have. However, if you hold them for at least 1 year before selling, you can get the more favorable tax treatments on your capital gains. And this is because long-term capital gains have better tax treatment than short-term capital gains, generally speaking. Oil and gas mutual funds are also another sector. Like oil and gas stocks, oil and gas mutual funds provide a way for investors to invest in oil and gas through the stock market, but oil and gas mutual funds are funds that pool capital from many different investors who invest in a wide variety of assets. Many people prefer mutual funds over individual stocks due to their higher levels of diversification and less risk. There are a wide variety of oil and gas mutual funds available to investors on the public stock exchange. For example, companies like Vanguard, Fidelity, and BlackRock all have mutual funds for the energy sector. Like oil and gas stocks, oil and gas mutual funds are subject to capital gains and dividend taxes, and they do not have many of the tax benefits that working interests have. The bottom line for oil and gas investing is that when it's done correctly, it's a great way to diversify your portfolio. You can generate some extra cash flow. You can even offset a huge portion of your income taxes. However, you should consult with a tax professional before investing in oil and gas to verify the tax benefits you will be eligible for before you decide to move forward. Okay, guys, that's all I got for today's video. If you want to work with my company or advance your tax knowledge further, I've included some links below in the description, and I would love for you to check them out. You know what to do. Like, comment, subscribe, and thank you so much for watching this video. I'll see you on the next one. Cheers.